All right, let's talk about inflation. CPI numbers have come out today at 6.3%. WPI numbers are even higher at above 12%. WPI numbers also because of a base effect. Overall, a disturbing trend as far as inflation goes, the highest in 6 months and definitely out of the tolerance band of the Reserve Bank of India. Outside is Laxman, Rekha, as we may say. But inflation is a worrying trend that we need to take cognizance of. Let me put it this way. Right now, if you had a fixed deposit, a fresh fixed deposit in any leading bank with a 5 to 10 year tenure, you would probably get about 5.4, 5.5% return. That means you basically make nothing at today's inflation rates. Think about what kind of increase, if at all, you're going to have in your income this year. Does it cross the 6.3% of inflation this year, or are you sliding downwards? That means you're saving even less. Think about the prices of everything in your kitchen, your household items recently. Think about healthcare costs going up, insurance premiums costs going up, and you get the broad picture. We are in a time of deep pain as far as inflation is concerned, and also at a time when regulators and the government can't do too much about it. So why are we in this situation and where do we go from here? Rahul Bajoria, Chief India Economist at Barclays, on the show with us this evening. Upasna Bhardwaj, Senior Economist at Kotak Mahindra Bank, joins us, as does Vineet Agarwal, President, ASSOCHAM. Welcome to all of you and thank you so much for speaking with us on the India development debate. Mr. Bajoria, I just want your take on the inflation numbers. It's been flagged off as a headwind that India needs to look at on a path of post-second wave recovery. The RBI didn't seem too concerned last time round, said this was supply-side constraints that were seeing inflation numbers spike. But do you think this is a matter of concern?
I think it should be concerning because I think what has happened, compared to even last year, we had high inflation, but I think the drivers of inflation are changing, compared to 2020. I think this year we have had more commodity price-led inflation. So the widening gap between WPI and CPI inflation is a reflection of on the ground, squeeze in margins that has come about. And we see this in several survey data as well. So if you look at PMI input and output cost surveys, they clearly show that, last year the margin widening has given way to a material squeeze in margins, for businesses. And as we see activity levels pick up, the ability to pass on higher commodity prices to consumers will increase. So I would be more worried about the medium-term implications of, this particular increase in commodity prices and what does that mean for consumer price inflation, because there is a risk that, we might see inflation pressures becoming a little bit more generalized. Already there are signs of it, at least in the food basket, and, core inflation as well remains very elevated. Now, obviously, the issue is that monetary policy cannot respond to it, but, the RBI certainly will not be happy with the numbers that have come out today.
Absolutely, but it's not like we can't do anything at all about it. Upasna, the big glaring elephant in the room is the fuel prices and the taxes on fuel prices. At least this should be enough of a nudge to the government to start cutting down on those excise duties on petrol and diesel.
Yes, actually, if you look at the budgeted numbers for the centre, then the centre had broadly assumed a much lower excise duty collections in the beginning of the year. And our estimates suggest about 6 rupees or so was a cut that was probably budgeted. But we haven't really seen that come through as of now. And given that there is a risk of fiscal, some kind of slippages that may arise because of the growth slowdown, clearly, the chances of any further rate excise duty cuts remain minimal, because there is a need for prioritization of expenditure, and more likely the government will try and compensate that through, not reducing the excise duty that is existing. So to that extent, I would say there is a challenge for the government as well. At this point where we stand, there are risks on the fiscal side. There is a need to ensure that spending is ramped up so that growth does not get affected going ahead. And keeping all of that in perspective, clearly this headline inflation coming at a 6.3% is, a big spoiler, I would say. And apart from excise duty, global side as well is not really helping. like Rahul mentioned, the import side inflation is continuously hammering, more reflected in the WPI for now. But we are seeing some pass-through in CPI as well. Food side and certain elements of supply side constraints are there, which will ease out as we go ahead because, the economy's restrictions will start getting moderated and we will see those at least supply side constraints, coming off. That should moderate. So I think there are parts which are transitory in nature, which should ease off. But there are still elements which will remain sticky and elevated. And we'll have to see how that really pans out going ahead. So it will be a challenge for the policymakers overall, I would say, to balance this growth and inflation scenario going ahead. But in the near term, because risks on the growth are much more visible and it needs to be tackled, it's going to be a challenge, but RBI will probably have to look through the near term, transitory nature of inflation and probably, this is a global phenomena. Across the world, we are seeing central banks really face this dilemma, and it's a thin line difference as to where they will see this sustain, and how much of this entire inflation is transitory, how much will it be passed through, and hence probably in the near term we would see across the board all central banks ignoring the upside, but they will have to tackle this as time passes by. So in the next 6 months or so, we see this as a very big challenge because we might see inflation becoming sticky.
Central banks may have to take a more nuanced approach looking at what the global scenario is. But at the end of the day, inflation is beginning to pinch and is beginning to hurt at all levels. Vineet Agarwal, I want you to give us perspective from the manufacturing side, from the corporate side, really. I mean, the commodity cycle is expected to be up for some time now. Crude prices are not looking like they're going to soften anytime soon. What are the kind of challenges that companies are facing, considering they can't really pass on too much of those increased costs as demand is already stifled?
Yes, Tamanna, I think, this time around, this is as Rahul also mentioned, the commodity prices are playing a big role in really driving up inflation. And at the manufacturing level, if we take the MSMEs, they are the ones who are really suffering this time around because in the last time, as we also saw, the big companies were able to bounce back quite rapidly. But the smaller companies are not only facing a muted demand scenario, they are also facing a liquidity issue because they're not getting paid fast enough. And now this triple whammy of really higher commodity prices from copper, steel to now even fuel. In the operating cost of a truck, for example, 40 to 50% is fuel. So it directly translates into higher fuel freight costs for everyone, whether be it at the factory level, at the farm gate level. So this is clearly adding fuel to the fire, if I may say so. So it is a struggle right now for all the MSMEs. On the larger side, overall capacity utilization in the country, as you know, is around in the mid-60s. So that is also not prompting any kind of new investment into towards supply. So that would mean that in the next few months, we would still see a little bit pressure on the supply side as well. But demand being slightly muted, maybe it gets locked off. But as we expect that the festival season should be good in terms of increasing demand, some of the supply side constraints can start to hit later on. The other good part, though, is that supply chains were not disrupted this time round like it was the last time. Last time with the full lockdown, all supply chains were broken, and it took much longer for it to come back. This time round, at least the supply chains are not broken. At least it's more or less intact. So yes, it is a challenging time. And I think we need the government stimulus in some ways, starting at the MSME level, to really start pushing growth as well as demand creation.
The question is that what is the kind of havoc this is wreaking on any kind of resumption of demand or improvement in demand, especially for non-discretionary items or non-essential items in Indian households? Mr. Bajoria, if you take into context, yesterday Union Minister Dharmendra Pradhan was asked why are taxes on fuel so high, and he said that, we've got to spend on vaccines, we've got to spend on welfare schemes, and hence the taxes are high. So the government is constrained from that end. But is there truly no way out where the government can ease the burden of inflation right now, because the Reserve Bank also seems constrained beyond a certain point to what they can do? What really can they do? This is not the time when they are going to increase interest rates. So what are the other policy measures that they have?
So I think a lot of it would really come down to, maybe trying to temper food prices at the margin, through certain supply side initiatives, or, try to import more food grains. But I think the difference between this year and last year's inflation, as Mr. Agarwal said, is that the supply chains are not actually disrupted. So it's not exactly coming, as a temporary shock, right? So to give you an example, this year, the food inflation is rising mostly in areas which require refrigeration, which require more, defined logistics, like fruits, like meat, which require cold chains, etc. So it is coming on the back of higher operating costs. And for India to try and, even if we cut taxes, say for fuel, and if it comes at the expense of a higher fiscal deficit, it might just mean, inflation coming and hitting us with a little bit of a lag, right? Because in India, I think the relationship between fiscal deficits and inflation is also reasonably well defined. So if it comes at the expense of higher borrowing costs or, higher borrowing needs, it may not necessarily be that, we'll be spared with the inflation shock, because ultimately somebody has to pick up the tab, right? So from that standpoint, I think imported inflation is something that really cannot be tackled. It has something, we just have to digest it. It will have implications for demand revival, I think. But more than that, I would say I completely agree with Mr. Agarwal's point that this is something that has more implications for the businesses in the near term, because what we have seen is that the margins have been squeezed. Unlike last year, when margins were expanding, this year there's been considerable squeezing of margins, and that is something that can hurt underlying profitability, even in an environment where, say, the top line revenue growths are looking reasonably okay, or, much better than what was the case last year.
Upasna, I want you to break it down for us on what this high inflation really means. Sometimes we end up discussing CPI and inflation numbers in a fairly detached manner. But right now, in the middle of a pandemic, and even as the second wave is waning, what does this really mean for incomes, for family incomes? Remember, a lot of expenses have gone up for many families, including healthcare expenses, out-of-pocket expenses that they're still grappling with. Savings have been eaten into and eroded. Incomes are hit at this point and continue to do so. In this context, what does a hike in CPI, the highest in 6 months, really mean in real terms?
Yeah, so clearly, I mean, you've actually said a couple of points here. If we look at the breakup of the inflation categories, we have seen health inflation pick up quite significantly. And now, given this kind of a surge that we're seeing, I would say part of that was probably a reason why, because May was seeing the peak of, the second wave, wherein the prices of health-related items, medicines, etc., was really peaking out. So part of that will moderate going ahead, firstly. But anyways, for now, given that inflation remains so elevated, clearly the purchasing power for all other commodities, all other segments is going to come down. So we cannot compromise on health-related or certain other categories of expenditure, and hence all other categories will come under stress. So other discretionary items could remain under stress for a while, as long as this pressure is going to remain intact. So we will see some moderation in all of this, like I said before, because some of it is transitory, some of it was happening because May was the month of peaking out of the second wave. So we do expect that this health-related expenses will moderate a little as we go ahead. But nonetheless, it does reduce or erode the purchasing power for for other discretionary items as we talk.
So, Vineet, explain to me, what do you see the impact of this on the festive season? Once again, like last year, one can imagine that if a third wave doesn't hit and we've vaccinated in sufficient numbers, industry will look to the festive season for some rejuvenation. With discretionary spends being hampered, do you see that making an impact on the festive season, or are you hoping things will turn around by then?
I'm an eternal optimist, and I think I would like to believe that the festival season should lead to a turnaround in the Indian economy. We saw that to some extent last year as well, and you've seen the global experience of what they call revenge shopping, or essentially the fact that people really want to get out once they are vaccinated, once they feel safe, and that's very critical. Of course, discretionary spending will be hit. But general spending should come back. I think, just refurbishing things or just the normal aspects of your life getting back to normalcy would mean that people should start looking at new clothes, be it new hardware or whatever that's essential. And also, I think we have to remember that things have changed from a perspective of how people shop. So it's online shopping, it's also omni-channel shopping, which is quite prevalent, as well as the fact that you need more digital devices, irrespective. You have online school that's going on. And this is not just at urban areas, but also in semi-rural, semi-urban areas as well. So clearly there should be some demand revival. Then for example, take things like automotive, where the demand for personal mobility is increasing because people don't want to travel in buses. So perhaps the two-wheeler segment should pick up. Definitely the four-wheeler at the lower end should pick up. And that has a consequent effect on a lot of other things. Clearly, once the demand picks up, there is impact on supply, there's impact on pricing as well. So because you get economies of scale. So I'm pretty confident that we should be able to see the growth of the economy during that period. But also we have to remember one more thing that's adding should help the economy is exports. This is a good time where a lot of companies have also focused on exports, using the advantage of the higher commodity prices actually in our favor, and use it to really export globally. So I'm quite positive that we should start seeing some good growth trends towards the Q3 of this year.
Yeah, and the other factor also to watch out for is that if we continue to have a decent monsoon and the rural sector shows some fillip over there, then that could help boost things. But for now, inflation, yes, is eating into your pocket, and frankly, there is a lot that can be done. Maybe it is time to think very, very surely and clearly about a cut in excise duties on fuel. Thank you so much to all of you for joining us on the first discussion.